Imagine waking up, pouring your morning coffee and just sitting down at your kitchen island.
Yeah, the classic morning routine.
Right, exactly.
Hmm.
So you open up your laptop, you check the pre-market ticker, and you see something that just makes you do a total double take.
Because the numbers are just, well, they're hard to process.
Exactly. $67 billion.
Just gone.
Just gone. That is the amount of market value completely wiped out from a 115-year-old tech giant before you even finish your first cup of coffee.
It's just wild.
And here's the picker for you to really chew on. This did not happen because of some massive Enron-style accounting scandals, right?
Yeah, not at all.
There's no sudden regulatory crackdown from the government. It happened because of a fundamental tectonic shift in how the world is choosing to spend its technology budget right now.
It really is a staggering amount of wealth to just evaporate in a single morning session, you know?
Yeah.
When you see a legacy blue chip company lose a quarter of its value that fast, it forces you to step back. It fundamentally reorients how we've got to think about the valuation of the entire enterprise software landscape.
Well, welcome to today's deep dive. If you are joining us today, you are probably trying to make sense of a market that feels like it's spinning in a dozen different directions at once.
Oh, absolutely. It's a mess out there.
It really is. So today, we're diving into a curated stack of fresh financial filings, deep dive earnings previews, and market updates, all centered around today's date, which is July 22, 2026.
And it is a very busy day for the markets.
Super busy. Specifically, we've got our hands on the official IBM 8K filing that just dropped, extensive earnings previews for both IBM and the software giant ServiceNow, and a really sobering market update from Charles Schwab.
Yeah, that Schwab report is heavy.
It is. So our mission today is to decode what might be the biggest structural shift in enterprise tech we've seen in a decade.
We're talking massive foundational changes.
Right. So we're going to unpack the macro pressure cooker of inflation and AI spending, deconstruct that historic 25% stock crash at IBM, look at how they plan to bounce back, and then, examine how this exact same tension is threatening companies that only sell software.
Exactly.
So if you're trying to figure out where the tech market is heading for the rest of 2026, you're absolutely in the right place.
You really can't look at a single company's stock chart in a vacuum right now, which is why starting with that Schwab report is so critical.
Right, the macro picture.
Yeah, the macroeconomic backdrop is arguably more volatile and influential right now than any individual earnings report coming out this week.
I'm really glad you brought that up because
Right.
looking at this Charles Schwab update, it feels incredibly tense.
Oh, for sure.
They highlight that inflation fears are creeping back into the picture. They mention global crude oil, specifically WTI, surging to a one-month high, pushing past $94 a barrel.
Which is a huge jump.
Right. And for anyone not trading commodities, WTI is West Texas Intermediate, which is basically the benchmark for U.S. oil prices.
Yeah.
The Schwab report notes this is a 26% rise from a sub-$70 low just earlier this month.
And that's not just a speculative bump.
Exactly. The catalysts are tangible, real-world events, right? We're talking strikes in the Middle East and severe shipping dangers.
Real physical bottlenecks.
Right. But here's my question for you. If you are a listener managing an IT department or you're just holding tech stocks in your 401k, why should you care about the price of a barrel of oil?
That's a very fair question.
Like, how does a shipping lane crisis ripple into the enterprise software sector?
It's a great question, and it all connects through the mechanism of interest rates and the broader supply chain.
Okay, walk me through that.
Well, software doesn't exist in the ether, right?
Right.
It runs on physical servers in massive data centers, which require immense amounts of electricity, which is obviously heavily tied to global energy markets.
That makes sense.
But even more directly, look at the clients buying the software. Let's say IBM is trying to sell a massive cloud architecture upgrade to a global logistics company.
Okay.
If that logistics company is suddenly paying 26% more for diesel fuel to run their fleets because crude oil just spiked, well, their operating margins get instantly crushed.
Right. Their costs just went through the roof.
Exactly. And when operating margins get crushed, the chief financial officer starts hunting for things to cut.
And I'm guessing IT budgets are a big target.
Oh, a massive target. Very often, multi-million-dollar software upgrades get delayed or slashed entirely just to keep the lights on.
So the rising price of oil literally eats the budget that was earmarked for tech upgrades.
Exactly. But the ripple effect gets even bigger when it hits the Federal Reserve.
The Fed, right?
Because when oil spikes, It injects inflationary pressure into the entire global economy. Transportation costs go up, manufacturing costs go up, consumer goods get more expensive.
The Fed hates that,
They despise it. That inflation data lands right on the desk of the Federal Reserve.
so they can't lower rates.
Exactly. The bond market looks at that $94 barrel of oil and realizes that the Fed might not be in a position to cut interest rates anytime soon. In fact, that Schwab update noted that Treasury yields are nearing their 2026 peaks.
Right, yeah. They highlighted the 10-year Treasury yield sitting at 4.63%.
Which is high.
It is. I always hear the 10-year yield described as the heartbeat of global finance. But let's break down why a 4.63% yield acts like gravity on tech stocks specifically.
Think about it this way. A share of a technology company is essentially a claim on all of the cash that company is going to generate in the future.
Because it's an investment in their growth.
Right. Because tech companies, especially software companies, are often priced based on massive growth expectations years down the line. Investors have to discount those future earnings back to today's dollars.
Okay, and the discount rate comes from the yield.
Yes. The rate they use to discount that future money is directly tied to the 10-year Treasury yield. So when the yield goes up, the discount rate goes up.
I see.
It's basic math, really. The higher the rate, the less those future dollars are worth today. It acts as a massive gravitational pull on valuations.
That makes total sense. If I can get a guaranteed, risk-free 4.63% return from the U.S. government, a tech company has to promise me massive, highly probable future growth to make me want to take the risk on their stock.
Precisely. Why take the risk otherwise?
And according to the Schwab report, the market is bracing for things to get even tighter. They referenced the CME FedWatch tool. What exactly is the market pricing in right now?
So the CME FedWatch tool is essentially a barometer for what futures traders think the Federal Reserve is going to do with interest rates.
And it's not looking good, right?
No, the numbers right now are hawkish. The odds of a Fed rate hike just next week jumped to 28%.
Wow, next week.
Yeah. And even more striking, the market is pricing in an 87% chance of at least one rate hike by the end of this year.
An 87% chance. That's practically a certainty in the eyes of Wall Street.
It basically is.
So we have this environment where borrowing money is incredibly expensive, operating costs are rising due to oil, and the Fed is likely to tighten the screws even more.
It's a lot of pressure.
It paints a pretty grim picture for technology spending.
It does, which is why the other side of this market dynamic is so completely fascinating.
What do you mean?
Well, despite that macroeconomic gravity pulling everything down, certain pockets of tech have been wildly volatile in the upward direction.
Oh, right, the AI stuff.
Exactly. Look at the PHLX semiconductor index.
Yeah, the Schwab note mentions it popped 5% in a single day recently.
5%.
For an entire index of the world's biggest chip makers. That is a massive move.
It's huge.
And the catalyst wasn't necessarily their own earnings, right? It was the anticipation of earnings from what the report calls hyperscalers like Alphabet and Tesla.
That's the crazy part.
So we have this bizarre tug of war happening. You've got macroeconomic gravity pulling the broader market down, but this absolute frenzy over AI hardware pulling the semiconductor space up.
That tug of war is the defining tension of the enterprise market right now. We are watching real-time attempts to price in what analysts are calling AI ROI, or the return on investment for artificial intelligence.
Okay, AI ROI. Let's unpack that.
So the hyperscalers, these are the massive cloud providers and tech giants who operate data centers on a global scale, are spending money at a rate that is difficult to comprehend.
Give me an example.
Take Alphabet. The market is tracking their capital expenditures, and we're talking about previously guided numbers of up to $190 billion for 2026, with expectations that it will rise even further in 2027.
I just want to pause on that number so the listener can really absorb it. $190 billion.
With a B.
That's not a corporate budget. That is roughly equivalent to the entire gross domestic product of a small European country.
It's astronomical.
And they are pouring it almost entirely into concrete data centers, cooling systems, and advanced silicon chips.
It's an unprecedented deployment of capital. They are effectively building the infrastructure for the next generation of computing. Right. But here's the friction point. The market is getting desperate for evidence that these massive AI spending sprees are actually going to pay off.
Because right now it's all just expense.
Exactly. It's one thing to buy hundreds of thousands of NVIDIA GPUs. It's an entirely different thing to generate profitable revenue from the AI tools you build on top of those GPUs.
So the market wants proof.
Yes. Investors are looking for actual user adoption, measurable productivity returns, and hard revenue growth stemming directly from that $190 billion bet.
Right, because if Alphabet or any other hyperscaler comes out on their earnings call and says, well, we spent the billions on the chips, but enterprise clients aren't quite ready to pay premium subscriptions for our AI agents yet, the entire semiconductor rally could just snap like a twig.
That's the vulnerability. And it brings up a really complex dynamic surrounding earnings expectations that the Schwab update touched on. They discuss the concept of whisper numbers.
Oh, I love the concept of whisper numbers.
It's so relevant right now.
It really is. The best way I can explain it to you if you're listening is to think of it like the secret menu at your favorite fast food joint.
That's a great way to look at it.
Right. Like, you look at the official menu board above the register, and that's the official consensus estimate. It's what the financial papers publish.
The standard order.
Exactly. But everyone standing in line who is really in the know, they're ordering the animal-style fries that aren't on the board. In Wall Street terms, the whisper number is the unofficial, highly optimistic expectation that institutional traders and hedge fund managers share with each other privately.
That's a perfect analogy. The official consensus might say a tech giant is expected to earn $2 a share for the quarter.
Okay.
But the whisper number, circulating in private chat rooms and Bloomberg terminal messages, might be $2.20.
So let's say the company reports $2.10. The headlines flash Company X beats estimates because they beat the official $2 mark.
Right, they clear the official bar.
But then you look at the ticker, and the stock is plummeting. And retail investors are sitting there scratching their heads. It falls because they missed the secret menu expectation.
That happens constantly. And it's not just about the past quarter's earnings, it's about the guidance for the next quarter.
The future spin.
Exactly. The whisper expectations for capital expenditure guidance right now are incredibly aggressive. If the market is whisper pricing in a massive raise in AI spending from these hyperscalers, and they only meet the official estimate, you'll see a sell-off.
Wow.
The market has priced in absolute perfection for AI hardware right now, and as we just discussed with oil and interest rates, perfection is very hard to achieve in this macro environment.
And just to add one more ingredient to this macro pressure cooker, the Schwab piece flags a looming September 30th government funding deadline in the U.S.
Yeah, that's another huge wild card.
We're staring down the barrel of a potential government shutdown. Plus, there's a proposed $70 billion defense spending bill hanging in the balance. How does political gridlock in Washington actually disrupt a fragile tech rally in Silicon Valley? I mean, we're keeping this strictly impartial, just looking at the market mechanics. But how do those gears connect?
It introduces immediate friction into the procurement cycle. A government shutdown doesn't just mean national parks close, it delays federal IT contracts.
And the government is a huge customer.
Massive.
Yeah.
For companies like IBM, ServiceNow, Microsoft, and Oracle, the federal government is one of their largest and most reliable clients. If those contracts are frozen, revenue recognition gets pushed to the right.
It just stalls out.
Furthermore, it shakes enterprise confidence across the board. If you are a CEO watching Washington fail to pass a temporary funding bill before an election, while geopolitical strikes are pushing up your oil costs and the Fed is threatening to hike rates,
You're not going to spend money.
exactly. You don't authorize a massive new software deployment. You sit on your hands. So when you combine all these factors, you have an environment with zero margin for error. Any company that shows a hint of weakness is going to be severely punished.
Which brings us to the main event. Let's look at the first massive victim of this exact tension. I want to unpack how this macro AI spending frenzy directly triggered the worst single trading day in IBM's 115-year history.
July 14th, 2026. That is a date that will undoubtedly be studied in business schools for a long time.
Let's set the scene. 8 days before their officially scheduled earnings call. The market is just doing its thing.
Just a normal Tuesday.
Right. And suddenly, IBM CEO Arvind Krishna releases an unscheduled preliminary letter to the market.
Which is never a good sign.
Never. Generally speaking, you never want to see an unscheduled preliminary letter. It's the corporate equivalent of getting a text from your significant other on a Sunday night that just says, "We need to talk."
Yeah, your stomach just drops.
Totally. And the result of that letter was catastrophic. The stock dropped over 25% in a single session. $67 billion in market value, completely gone.
The sheer magnitude of that drop is what caught institutional investors totally off guard.
Because it's IBM.
Exactly. A 25% haircut for a hypergrowth tech startup is somewhat normal. A 25% drop for a $200 billion legacy blue chip company that pays a reliable dividend is practically unheard of.
It's massive.
It signaled a panic that went far beyond a single bad quarter.
I really want to look closely at the preliminary numbers they released that caused this panic, because on the surface, they don't look apocalyptic.
They really don't.
They reported $17.2 billion in revenue, which was actually up 1% year over year. Their adjusted earnings per share, or EPS, was $2.93.
Solid numbers in a vacuum.
Right. The pain point was that this revenue figure was a miss of roughly $660 million compared to the $17.86 billion Wall Street estimate.
Yeah.
But I really have to push back on the market logic here.
Okay, let's hear it.
I'm looking at this math and it just doesn't add up. They miss revenue expectations by $660 million, and in response, the market punishes them by erasing $67 billion in total value.
It's a huge multiplier.
The penalty is 100 times the size of the crime. What is the real story here?
You're entirely right that the math doesn't make sense if you only look at the historical ledger of what happened in Q2. But the stock market is a forward-looking mechanism.
All right, it's about the future.
It doesn't trade on the past 90 days. It trades on the discounted cash flows of the next decade. The crash wasn't about the $660 million miss. It was entirely about the explanation Arvind Krishna gave for why they missed.
Oh, the commentary in the letter.
Yes. He cited two massive structural factors that struck absolute terror into the heart of every software investor out there.
Okay, let's break those down, because this is where the rubber meets the road. Factor number one, a cybersecurity distraction.
That's right. Krishna noted in the letter that enterprise clients were actively pausing their software spending to assess new AI tools.
Pausing to assess.
Yeah, and he specifically called out Anthropic's new Mythos model. We've talked about frontier AI models before, but the introduction of these hyper-advanced tools is creating a massive cybersecurity dilemma for large corporations.
How so? Walk me through what that actually looks like inside a company. Let's say I'm the chief information officer at a major bank. Why does a new AI model from Anthropic stop me from buying IBM software?
Well, if you're that CIO, your primary job is data security.
Right.
Suddenly, every department in your bank wants to use this new Mythos model to write code, draft emails, and analyze financial data.
Because it makes them faster.
Exactly. But you don't know where that data is going. You don't know the vulnerabilities of the model.
Oh, I see.
Before you can commit tens of millions of dollars to a massive multi-year legacy software contract with IBM, you have to stop everything and figure out your enterprise AI security posture.
You have to pump the brakes.
You have to audit your entire data pipeline to ensure proprietary bank data isn't leaking into a public AI training set. So the procurement team just freezes. The sales cycle elongates. It's an industry-wide distraction.
That makes total sense. It's not necessarily that they don't want the IBM software upgrade. It's that they are just too overwhelmed dealing with the existential security threat and operational changes of a new AI model to sign the paperwork for anything else right now.
Exactly. It's a bandwidth issue. But while that first factor is a headache, the second factor Krishna outlined is much more structural and, frankly, far more terrifying for a company like IBM.
Okay, what was it?
He pointed to a massive shift in client capital expenditure. Enterprise clients aren't just distracted, they are actively raiding their software and services budgets in order to buy physical AI hardware.
Wow.
We're talking servers, specialized storage, and memory.
Why the sudden, desperate rush for hardware in late June? I mean, I get that AI requires chips, but why cannibalize your software budget for it right this second?
Because there is a global memory shortage, specifically in high bandwidth memory, or HBM, which is crucial for running AI accelerators.
Oh, so it's a supply chain panic.
Exactly. Enterprise clients are trying to front-run expected price hikes. They know that the physical components required to run on-premise AI are getting incredibly scarce and increasingly expensive.
Right.
So put yourself back in the shoes of that CIO. You have a fixed annual IT budget. You know memory prices are going to skyrocket next month. You have to make a choice.
You rob Peter to pay Paul.
Exactly. You take the money you're going to spend on an IBM software renewal, and you use it to stockpile physical servers and memory drives instead, just to ensure you have the compute power you need for next year.
Oh, wow. So IBM's clients are basically calling their sales reps and saying, look, we love your hybrid cloud software, but we have to stockpile NVIDIA chips and high bandwidth memory drives before they get too expensive, so we're tapping out for this quarter.
That's exactly the conversation happening.
That completely explains the $67 billion wipeout. The market isn't reacting to a sluggish quarter. The market is reacting to the possibility that AI hardware is going to structurally cannibalize legacy software budgets for the foreseeable future.
You've hit the nail on the head. If this isn't a temporary timing issue, but rather a permanent structural shift in how corporations allocate their IT budgets, then IBM's future revenue projections are entirely wrong.
The whole model breaks.
And the analyst community completely fractured on how to interpret this news. If you look at the research notes from July 14th, you see total market confusion.
Yeah, looking at the preview materials, the spread in analyst targets is just wild. On one hand, you have HSBC. They looked at the warning and slashed their price target for IBM down to $175.
Makes sense based on the panic.
But then you have Stifel. Stifel actually raised their target to $235 on the exact same day the stock crashed.
Yeah, they doubled down.
How did two professional Wall Street analysts look at the same disastrous letter and come up with completely opposite conclusions?
It really comes down to how they value the underlying assets. The IND Money preview used a great analogy of a used car.
Okay, let's hear it.
Imagine you take your car to two different mechanics. The first mechanic, HSBC, looks under the hood, hears the engine sputtering, and says, "This car is dying, it's barely worth anything."
Right.
But the second mechanic, Stifel, looks at it and says, "Well, the engine might be stalling, but you've got brand new tires, a pristine transmission, and a rare exhaust system. If you take this car apart and sell the parts individually, you'll make a fortune."
Ah, a sum of the parts valuation.
Precisely. Stifel is arguing that the market is massively overreacting to a temporary hardware buying panic, and in doing so, they are ignoring the underlying value of IBM's individual assets.
And what's the biggest piece of that?
The biggest piece of that puzzle is Red Hat. IBM bought Red Hat in 2019 for roughly $34 billion.
Right, I don't know that.
Stifel argues that today, based on its growth and strategic importance in hybrid cloud environments, Red Hat alone is worth nearly $63 billion.
Wow, just Red Hat alone.
Yeah. Stifel's math suggests that if you broke IBM up into its constituent pieces, software, consulting, infrastructure, these pieces are worth $257 billion combined.
Which is way higher.
That is vastly more than the $200 billion market cap the stock fell to after the crash.
I hear that, but untangling a 115-year-old enterprise tech company isn't like taking apart a Lego set, right?
No, it's a nightmare.
These divisions share massive global sales teams, intertwined IT infrastructure, and overlapping client accounts. You can't just slice off Red Hat and sell it without causing a massive operational disruption to the rest of the business.
You really can't. And to be fair, Stifel admits a corporate breakup is highly unlikely.
Okay.
But the fact that Wall Street analysts are even publishing notes exploring a breakup scenario tells you how volatile the sentiment around IBM's management has become.
It shows the lack of confidence.
Exactly.
Right.
When a company's standalone parts are mathematically modeled to be worth more than the unified whole, it signals a deep lack of faith in the executive team's ability to execute a cohesive strategy.
So we fully understand the trauma of July 14th. The market was spooked by the hardware cannibalization theory.
Right.
Now, let's fast forward to today, July 22, 2026. The dust has somewhat settled, and IBM just officially filed their 8K with the actual finalized Q2 results and their guidance for the rest of the year.
The official numbers.
Let's unpack this official document to see how Arvind Krishna and his team plan to dig themselves out of this hole.
The official 8K is crucial because while it confirms the top-line numbers from the preliminary warning, it gives us the granular segment breakdown.
We need to see where it hurts.
Right. To understand a company as complex as IBM, you have to look at the individual moving parts to see where the bleeding actually happened.
Okay, let's go segment by segment. First, software. It actually grew 5%, hitting $7.8 billion.
That's a solid number.
And within that, hybrid cloud, which includes that highly valued Red Hat asset we just talked about, was up 11%. So software actually looks relatively healthy.
Yeah, it held up well.
Next is consulting, which was basically flat at $5.3 billion.
Not great. Not terrible.
But then we hit infrastructure. Infrastructure dropped a painful 7% to $3.8 billion. And looking at the notes, that was heavily dragged down by a massive 42% drop in something called IBM-Z.
Yes, IBM-Z.
What is IBM-Z and why did it fall off a cliff?
So IBM-Z is their mainframe business. And I know the word mainframe sounds like something out of a 1970s sci-fi movie, but they are the absolute backbone of the global financial system.
They still use mainframes.
Oh, everywhere. The massive servers that process billions of credit card transactions a day. Those are IBM Z mainframes.
Oh,
Now, a 42% drop sounds catastrophic, but we have to provide the mechanical context of how hardware is sold. Mainframes run on very strict product cycles.
meaning they don't buy them every month.
Right. When a new mainframe is released, there is a massive spike in sales as banks upgrade, followed by a long lull. IBM announced their new Z17 and Linux-owned configurations in early July, with general availability scheduled for August.
Oh, I see. So it's the classic Osborne effect.
Yeah.
If you know Apple is releasing the iPhone 16 in September, you aren't going to walk into a store and buy the iPhone 15 in July. You hold on to your cash and wait.
That's the exact mechanism at play. Enterprise clients aren't abandoning the mainframe. They're just holding off their multi-million-dollar purchase orders, waiting for the new models to physically drop in Q3.
So a massive drop in Q2 infrastructure revenue actually makes logical sense.
It does. And in fact, within that very same infrastructure segment, their distributed infrastructure sales were actually up 37%.
Oh, wow, up 37%.
Yeah, so the narrative that IBM's hardware division is collapsing entirely just isn't accurate.
But the real star of this 8K filing, the thing every investor was looking for, is the future guidance.
Yes, this was the big test.
The market was holding its collective breath, waiting to see if IBM would capitulate and slash their full-year outlook based on that hardware cannibalization fear, and they didn't.
Nope, they held firm.
The 8K states they expect 4 to 5% full-year constant currency revenue growth. Even more importantly, they expect free cash flow to increase by about $1 billion year over year. Why is reaffirming that specific free cash flow metric such a big deal?
Reaffirming that guidance is a massive, confident statement from management. Free cash flow is the lifeblood of a mature company.
It's the actual money in the bank.
Right. It's the actual cash left over after paying for operating expenses and capital expenditures. You can massage revenue numbers with accounting tricks, but you can't fake free cash flow.
Exactly.
By stating they will increase it by $1 billion, management is essentially drawing a line in the sand. They are telling the market, look, July 14th was a timing issue. The deals were delayed by the cybersecurity distraction, but they are not destroyed.
Right.
If they can genuinely increase free cash flow by $1 billion while navigating this chaotic AI hardware budget shift, it proves their underlying business model is far more resilient than the 25% crash implied.
And they also made sure to throw a bone to their traditional investor base. They announced the approval of a $1.69 quarterly dividend. I found this stat in the filing just mind-blowing.
It's a crazy stat.
This is their 31st straight year of dividend increases, and they have paid a consecutive quarterly dividend every single year since 1916.
Since 1916, just think about the history in that statement.
That's over a century.
They paid a dividend through the Great Depression, World War II, the dot-com bust, and the 2008 financial crisis.
Unbelievable.
That dividend is the ultimate comfort food for a rattled institutional investor. It signals deep, unshakable financial stability. You simply do not maintain a 110-year dividend streak if your executive team believes the company is facing an existential crisis.
But IBM isn't just relying on century-old dividends to win back Wall Street's favor, right? They are pivoting incredibly hard to a strategy they are calling rapid innovation at scale.
Yeah, they're playing offense.
I want to talk about a specific tool highlighted in the 8K called Lightwell. It's described as a new open-source security capability.
Very important tool.
It says here it pushed out 7,500 patches in its first 2 weeks and is already being adopted by heavy hitters like Bank of America, Citi, Goldman Sachs, and JP Morgan Chase. What exactly does Lightwell do, and why is it so strategic right now?
Lightwell is a brilliant, highly targeted strategic maneuver. Let's go back to the first reason Arvind Krishna gave for the July 14th earnings miss.
The cybersecurity distraction.
Right, the distraction caused by new AI models like Anthropic's Mythos. Lightwell is IBM's direct mechanical answer to that exact distraction.
Okay, how does it work?
Think about how a bank manages security. If a new vulnerability is discovered in an open-source AI tool, human engineers have to manually locate every instance of that software across thousands of servers, test a patch, and deploy it.
Sounds incredibly tedious.
It takes weeks. Lightwell automates that across the enterprise instantly.
So it's basically an automated immune system for a bank's IT infrastructure.
That's a perfect way to conceptualize it. They are telling these massive financial clients, we know you are terrified of securing open source AI vulnerabilities. We know it's freezing your budgets. Here is a massive automated patching system already battle tested by the biggest banks in the world.
Problem solved?
Exactly. By solving the exact operational friction point that caused their Q2 software deals to stall, IBM is aggressively clearing the runway to get those contracts signed in Q3.
It's a really smart fix. But I have to ask you about the other massive headline-grabbing pivot in this 8K. It's all about quantum computing.
Ah, yes, Anduril.
IBM announced a letter of intent with the U.S. Department of Commerce to build something called Anduril. They describe it as the world's first pure-play quantum wafer foundry.
It sounds very sci-fi.
It does. They're committing over $10 billion to quantum computing over the next 5 years, with the stated goal to deliver a fault-tolerant system by 2029.
That's a huge commitment.
Before we get to the financial strategy, can you just give us a quick primer on what a pure-play quantum foundry is and what fault-tolerant actually means?
Sure. So quantum computing doesn't use traditional binary bits, ones and zeros. It uses qubits, which can exist in multiple states at once, allowing for exponentially faster calculations for specific problems like chemical simulation or cryptography.
Okay.
But qubits are incredibly sensitive. Any heat, any vibration, and they lose their state. That's called noise.
So they break easily.
Yes. A fault-tolerant system is the holy grail. It means the system has enough error-correcting qubits built in that it can run continuous complex calculations without crashing due to that noise.
And the foundry part.
A pure-play quantum wafer foundry means they are building a massive physical manufacturing plant dedicated exclusively to printing these highly specialized quantum chips rather than retrofitting old silicon fabs.
Okay, so technologically it's a total moonshot. But I have to put my skeptical hat on here. My question to you is this. Is this $10 billion quantum leap a brilliant long-term business play, or is management just pointing to a shiny futuristic object to distract investors from the fact that they missed their software revenue estimates today?
It's entirely possible that it's both.
Really? Both?
Yeah. I mean, from a purely technological and geopolitical standpoint, achieving a fault-tolerant quantum computer by 2029 would fundamentally alter global computing power.
True.
And partnering with the U.S. Department of Commerce means this is tied to national security. A $10 billion capital deployment over 5 years is not just a PR stunt. You don't spend that kind of money just to win a news cycle.
That's a lot of real money.
Exactly. However, from a capital markets perspective, the timing of this massive announcement is remarkably convenient.
Very convenient.
It completely changes the narrative. Instead of the financial media debating a $660 million software miss, Jim Cramer and the analysts are suddenly forced to debate the geopolitical implications of a $10 billion quantum foundry.
It's the ultimate narrative reset. Like, don't look at the delayed cloud contracts, look at the quantum future.
Exactly. Look over here.
But will Wall Street actually buy it? The I&D Money preview noted that based on options pricing, the market was implying a 7% move for the stock today based on this 8K filing.
7% is big.
7% on a $200 billion company is a massive, violent swing. Is reaffirming the 4 to 5% guidance and pointing to quantum enough to convince the market that the July 14th crash was just a temporary timing issue rather than a sign of deep structural rot.
The options market is pricing in that extreme volatility because the fundamental trust between management and investors has been broken.
They got burned.
Yeah. When an executive team surprises the market with a massive miss just 8 days before earnings, the market loses faith in their forecasting.
Right.
Reaffirming the guidance is the necessary first step to stopping the bleeding, but trust isn't rebuilt in a single 8K filing.
They need to prove it.
Exactly. The market will be watching the Q3 numbers like a hawk. If those delayed software deals that Krishna promised would close don't actually materialize in the fall, the quantum foundry narrative won't be enough to save the stock from another severe repricing.
So if we pull the lens back, what does this all mean for the rest of the enterprise technology industry?
This is where it gets really interesting.
Because if IBM's clients who buy a mix of hardware, consulting, and software are raiding their software budgets to buy AI chips, what happens to the companies that only sell software?
The pure plays.
Right, the companies that don't have a hardware or consulting division to fall back on. This brings us to the highly anticipated earnings of the pure-play SaaS giant ServiceNow, who reports tomorrow.
ServiceNow is the perfect litmus test for this entire structural rot theory we've been discussing.
How so?
Well, if IBM's warning was just an execution problem specific to IBM's sales team, ServiceNow should sail through their earnings tomorrow completely fine. But if IBM's warning was a canary in the coal mine for an industry-wide software budget freeze, ServiceNow is going to feel the pain, and they are going to feel it acutely.
Let's do a quick flashback to ServiceNow's Q1 earnings back in April, because it perfectly illustrates how fragile software valuations are right now.
Oh, that Q1 report was a bloodbath.
By all traditional metrics, they had a nearly flawless quarter. Revenue came in at $3.77 billion, which was up 22%.
Huge growth.
Their CRPO, metric we are going to dive deep into in a second, was up 22.5%. They beat basically every consensus expectation on the board.
A total sweep.
Yet the stock crashed 17.75% the very next day. It was their worst single trading day in company history. Why does a company post 22% growth and lose nearly a fifth of its value overnight?
Because in the world of high valuation SaaS software as a service, the past doesn't matter.
It's all about what's next.
Exactly. It was all about the guidance. The market reacted violently to two specific things management said about the future. First, they guided their Q2 CRPO down to 19.5%. Second, they trimmed their full-year operating margin and free cash flow margin guidance.
Let's tackle the margin trim first. I read they blamed that on the early close of a major acquisition. They bought a company called Amidst for $7.75 billion, right?
Yes, Amidst is an enterprise cybersecurity firm. It's a massive, highly strategic deal. The transaction closed earlier in the quarter than they initially projected.
Okay, so how does an early close hurt margins?
Well, while closing early adds Amidst's revenue to ServiceNow's top line faster, it also means ServiceNow has to absorb all the immediate heavy integration costs, legal fees, restructuring, combining IT systems earlier than expected.
So it pulls the expenses forward.
Right. That drags down their operating margins for the current year. But frankly, the market usually looks past acquisition accounting excuses. The real panic was focused entirely on the CRPO deceleration.
Okay, we need to spend some time explaining CRPO because if you were trying to understand software stocks today, this is the most important acronym you can learn.
It really is the holy grail metric.
It stands for Current Remaining Performance Obligations. In plain English, it's a measure of next 12-month bookings.
Revenue under contract.
Exactly. It's the revenue that clients have legally committed to paying, but hasn't been recognized yet because the service hasn't been fully delivered over the year. Think of CRPO as the speed of a train approaching a station.
I like this analogy.
In Q1, that revenue train was hurtling down the tracks at a 21% growth rate. For Q2, management told investors they are applying the brakes, slowing the train down to 19.5%. The market's panic isn't about the train stopping entirely. It's about whether the brakes are grabbing harder than management is willing to admit.
I really like that train analogy because it captures the momentum aspect of software valuation.
It's all about momentum.
Software companies command massive premium valuations because their revenue is supposed to be highly predictable. Unlike a company that sells physical goods and starts at zero every quarter, a SaaS company relies on recurring subscriptions.
Right, the subscription model.
The market pays a high multiple for ServiceNow because they believe that train is going to compound at 20+% reliably for years to come. When management taps the brakes, even slightly, the market has to reevaluate the entire duration of the journey.
The IND Money preview calls tomorrow's print the 150 basis point verdict. Management guided a slowdown from roughly 21% to 19.5%. That's a 150 basis point drop in growth. Tomorrow, all eyes in the financial world are on whether they actually hit that 19.5% mark.
The stakes for that specific number are incredibly high.
What happens if they hit it?
If ServiceNow hits 19.5% or comes in slightly higher, it signals to the market that the deceleration is on schedule, fully modeled, and completely under control. The stock likely rallies.
Okay, and if they miss?
But if they miss that target and fall under 17.5%, it is an absolute disaster for the entire software sector.
Why is 17.5% the magic disaster threshold? What does that specific miss signal?
Because dropping below 17.5% would mean the rate of deceleration is actually accelerating.
The brakes are locking up?
Exactly. It means the train isn't just slowing down to coast into the station, the brakes are locking up. If ServiceNow misses that badly, it gives massive, undeniable ammunition to the bears who think IBM's warning wasn't an isolated incident, but an industry-wide contagion.
That would be brutal.
It would prove that enterprise clients aren't just slightly delaying their ServiceNow deployments, they are actively halting them to divert those funds to NVIDIA hardware.
And we also have to layer the geopolitics back into this equation.
Always back to the macro.
Right. In Q1, ServiceNow noted a 75 basis point loss in subscription growth, specifically due to delayed on-premise deal closings resulting from the conflict in the Middle East. This ties directly back to that Charles Schwab macro update we started with.
It really does circle back.
If oil is spiking because of shipping lane dangers and regional supply chains are threatened, physical IT deployments in those regions become incredibly difficult.
Exactly. When you deploy an on-premise software solution, meaning you are installing the software directly on the client's physical servers rather than hosting it in the cloud, you often need specialized engineers physically on site to handle the integration.
And if you can't fly them there.
Right. If there is geopolitical instability, you can't send your engineers in, and the client delays the contract. So you have these macroeconomic and geopolitical delays layering directly on top of the AI hardware budget shifts. It is a perfect storm for a software bookings miss.
This brings us to the ultimate existential question hovering over both IBM and ServiceNow, and frankly, the entire technology sector.
The big one.
As you listen to this, think about the tools you use every day at work. Is AI fundamentally a tool that software companies can integrate and monetize, or is it a replacement technology that will ultimately destroy their core business models?
That is the trillion-dollar question that every venture capitalist and public market investor is trying to answer right now.
Nobody really knows yet.
And to their credit, ServiceNow is fighting aggressively to prove that AI is a tool they can highly monetize.
Let's look at their ammunition in this fight. They are pushing something called Now Assist. They recently raised their 2026 AI ACV, which is annual contract value target, by 50%, jumping from $1 billion to $1.5 billion in expected revenue just from AI features.
That's aggressive growth.
The data shows that customers spending over $1 million on Now Assist grew by over 130% year over year. And at their massive user conference in May, they unveiled these highly specialized AI agents designed for specific workflows: IT, CRM, HR, and legal.
Really leaning into it.
They are heavily marketing AI as a premium must-have add-on to their existing software platform.
They absolutely have to push that narrative. They need to show Wall Street that AI is an accretive revenue stream, meaning it adds money on top of their existing contracts.
It's an upsell.
Exactly. If they can convince a client paying $100,000 a year to pay $120,000 a year to get the AI features, that's a massive win.
Right.
But Wall Street analysts are starting to look past the marketing hype and examine the underlying fundamental mechanics of how enterprise software is actually sold. Historically, companies like ServiceNow make their money on a per-seat licensing model.
Right, the classic per-seat model. Let's break that down for anyone unfamiliar. If a Fortune 500 company has 1,000 employees in their human resources department, they have to buy 1,000 individual ServiceNow licenses so every employee can log into the system.
Correct. Their revenue scales linearly with human headcount.
More humans, more money.
Exactly. But let's run a thought experiment on what happens if ServiceNow's new AI specialists are actually as incredibly efficient as they claim they are.
Okay, let's play this out.
What if one of these new AI agents can autonomously handle the routine workflow of 5 human HR employees, processing onboarding paperwork, answering benefits questions, routing approvals?
The AI does all the heavy lifting.
Suddenly, that Fortune 500 company realizes they don't need 1,000 human HR employees to function. They only need 200 humans overseeing the AI agents.
Oh, I see where this is going.
And if they only have 200 human employees, they only need to purchase 200 ServiceNow licenses next year.
Oh, wow. That is a brutal paradox. So by making their own software incredibly efficient with these amazing AI agents, they might actually be cannibalizing their own licensing volume.
It's a catch-22.
They are solving their client's efficiency problem, but in doing so, they are destroying the very metric seat count that drives their own revenue. Are we legitimately seeing the beginning of AI eating legacy software?
That exact fear is what is driving the massive valuation compression we are seeing across the entire SaaS sector right now.
It's a real fear.
Investors don't know how to model a company's revenue 3 years from now if the seat count is going to shrink drastically. Look at ServiceNow's current valuation. They are trading at roughly 22.6 times forward earnings.
Now, to be fair, 22.6 times forward earnings is still significantly higher than the broader IT industry average, which sits at around 16.6.
That's true.
And it's much higher than legacy peers like Oracle at 14.8 or Salesforce down at 11.7. So the market still views them as a premium asset.
They do, but it is a massive, painful drop from ServiceNow's own historical highs. Their enterprise value to sales ratio has been crushed. It's currently sitting at about a third of its 52-week high.
A third. That's a huge haircut.
The market is aggressively discounting their future cash flows because the fundamental architecture of software revenue is in question. They literally don't know how to model a world where autonomous agents replace human seats.
I have to push back on the market's extreme pessimism here, though. Let's look at the actual reality on the ground today.
Okay, let's look at it.
If ServiceNow's revenue is still compounding at over 20% year over year right now, and their renewal rates, the percentage of clients who re-sign their contracts are holding incredibly steady at 97%, isn't Wall Street just being notoriously incredibly impatient?
Well, they often are.
It feels like the market is throwing a tantrum, simply because traditional software isn't growing at the absurd triple-digit pace of a hardware company like NVIDIA.
It's a fair criticism. Wall Street is notoriously impatient and prone to herd mentality.
Big time.
But their underlying anxiety isn't entirely unfounded. You have to remember the difference between backward-looking metrics and forward-looking valuation.
Right, 97% is past performance.
Exactly. A 97% renewal rate is fantastic, but it's backward-looking. It tells you that clients really liked the software last year, before the massive AI models were fully integrated. Valuation looks entirely forward.
So they're pricing in the unknown.
The stock market isn't reacting to today's 20% growth. It is reacting to the mathematical possibility that in 2027 or 2028, the per-seat model will systematically collapse.
It's all about risk.
They are pricing in the risk of total disruption. And when a stock like ServiceNow is priced for absolute perfection, even the faint whisper of disruption causes institutional managers to hit the sell button and rotate into hardware.
It is an incredible, terrifying tightrope these companies are walking today. Let's recap this, because the sheer scale and complexity of the forces at play here are truly mind-bending when you put them all together.
It truly is a precarious moment. We are at an inflection point for enterprise technology that we haven't seen since the transition from on-premise servers to the cloud a decade ago.
On one side, you have this relentless macro pressure cooker. Tech companies have to navigate a world where creeping inflation and sudden spikes in global crude oil can wipe out their clients' margins overnight.
The macro environment is unforgiving.
They have to deal with a hawkish Federal Reserve keeping borrowing costs near 2026 highs, making capital incredibly expensive. And above all, they have to prove to a skeptical Wall Street that the $190 billion AI capital expenditure sprees are actually yielding a real return on investment, not just building massive, expensive data centers to nowhere.
And then on the micro level, down in the trenches, these legacy giants have to navigate the rapidly shifting priorities of their own clients.
Right, the CIOs are panicked.
IBM's historic 25% stock crash wasn't just a bad day at the office. It was a loud, blaring warning siren that enterprise IT budgets are finite. When a CIO feels the pressure to front-run global memory shortages and hoard AI hardware, the legacy software budget is always going to be the first casualty.
Which puts the pure-play software giants, companies like ServiceNow, directly in the crosshairs tomorrow. They don't have a mainframe division or a quantum foundry to point to.
They just have their core software.
They have to maintain flawless 20+% growth. They have to manage the insanely high expectations of those Wall Street whisper numbers. And most importantly, they have to fundamentally convince the market that AI is a premium feature they can charge extra for, not a replacement technology that will systematically destroy their core per-seat business model.
The burden of proof has entirely shifted. For the last 5 years, the market blindly assumed the dominance of the SaaS model. Now, those software companies must earn their multiples back, quarter by brutal quarter, proving their relevance in an AI-first world.
It brings us right back to that $67 billion vaporized market cap we talked about at the very beginning of the show.
Full circle.
It wasn't an accounting error. It wasn't a glitch in the matrix. It was the collective market abruptly, violently changing its mind about what the future of work actually looks like.
That's the reality we're in now.
So as you watch these tech earnings roll in over the next few weeks, I want to leave you with this final thought to ponder.
It's a big one.
If AI truly scales over the next few years to the point where autonomous digital agents significantly outnumber human employees in the corporate world, how will we even value a software company? If the per-seat license model truly dies, are we currently looking at the final days of the SaaS era as we know it?
It's definitely something to think about.
Something to think about next time you log into your workflow dashboard. That's our deep dive for today. Keep an eye on those earnings, and we'll see you next time.